Before we jump into the material today, we actually need to cover a quick mandatory legal disclaimer.
Right, the fun stuff.
Yeah, exactly. So, this deep dive is strictly for educational and informational purposes only. It is absolutely unequivocally not financial advice, and it doesn't constitute an offer, a solicitation, or, a recommendation of any investment product.
We're just analyzing historical market data today.
Right.
We're not predicting the future here.
Right, because investing involves real risk, and you should always do your own research or consult with a certified financial professional before making any decisions with your money.
Basically, we're here to provide context based on the sources we have, not to act as a crystal ball.
Okay, disclaimer out of the way. So, I want you to imagine sprinting the first 100 meters of a marathon, throwing your hands up in victory, and then just running face first into a solid brick wall.
Ouch. Yeah, that's a pretty accurate visual.
Right, because if you have looked at your retirement portfolio in the last, I don't know, 6 weeks, navigating mid-March of 2026, that is exactly what this year feels like so far.
Oh, absolutely.
You
Right.
likely had this massive sugar rush in January, only to watch the market just slowly, agonizingly bleed out. You might even be hovering your mouse over the sell button right now.
Yeah, feeling like all that momentum just completely vanished. And, I mean, it's an incredibly disorienting environment for anyone holding equities right now.
Totally.
If you look at the financial terminals, it shows a market that has seemingly lost its compass. But, when human nature meets financial chaos, our immediate instinct is to just scan the horizon for a pattern.
We want a map. We want something to tell us if this is just a temporary stumble or the beginning of a massive crash.
Exactly. And because everybody's looking for that map, there has been a deafening amount of media chatter lately,
Yeah.
comparing a current reality in 2026 to the year 1994.
Yeah, it's everywhere. But instead of just repeating those panicked headlines, we brought a stack of hard data to the table for today's deep dive.
The real numbers.
Right. We have transcripts analyzing the broader macroeconomic forces of 2026 versus 1994, paired with 6 incredibly detailed data visualizations. We're talking fractal market charts, daily heartbeat overlays of the S&P 500, and historical midterm averages.
It's just a phenomenal stack of sources to work through.
Yeah.
We've got historical pricing data matched against Federal Reserve archives and cross-referenced with U.S. Bureau of Labor Statistics records.
So the mission here is to just cut right through that media panic. We want to use raw historical data to understand exactly what is happening under the hood of the market right now, mechanically speaking.
Right, and to figure out what you might actually expect for the rest of the year based on that precedent.
Okay, let's unpack this. Let's start with the immediate pain. The charts in our sources show a nearly identical structural shape between the first quarter of 1994 and the first quarter of 2026.
Yeah, financial analysts call this specific pattern the Q1 Whipsaw, or sometimes the false start.
Which goes right back to that marathon runner analogy. Let's look at the 2026 reality first. So January of this year was entirely driven by this euphoric AI infrastructure boom, right?
Oh yeah, it was massive.
By day 20 of the trading year, the market had marched straight up to a positive 3.5% year-to-date return. Wall Street genuinely believed inflation was dead, and the Fed was about to start handing out rate cuts like candy.
The optimism was entirely priced in. But then February arrived, and our runner hit that brick wall.
The oil shock.
Exactly. A severe geopolitical conflict involving the U.S., Israel, and Iran rapidly escalated. And the immediate symptom of that disruption was a massive oil spike.
Right. Brent crude pushed past $84 a barrel.
Yeah. And when global energy prices spike like that, it acts like a tax on the entire global supply chain. It just bleeds into the cost of manufacturing, shipping, everyday goods.
Which means the consumer price index, the primary measure of inflation, stayed incredibly sticky.
Sticky CPI means no Fed rate cuts. Their hands are tied. They cannot possibly justify cutting interest rates when the cost of living is still that elevated.
And the moment Wall Street woke up to that reality, the momentum just snapped. According to the daily heartbeat charts we have here, that realization triggered the March bleed.
It was brutal.
Yeah, we watched the market drag down from that 3.5% peak all the way down to negative 1.3%, or negative 1.5 depending on the daily metric, by day 50, which is exactly where we are sitting right now in mid-March.
So now let's rewind the tape and look at the 1994 twin. If you map the historical data for the S&P 500 over that exact same time frame, the structure is astonishingly similar.
Oh, wow.
Yeah. In January 1994, investors had also convinced themselves that inflation was ancient history. The market surged. peaking at positive 3.4%.
Wait, 3.4? That is virtually identical to our 2026 peak of 3.5%.
I know, it's wild, but they obviously weren't dealing with the exact same Middle East oil shock we are right now.
Right, so what was their brick wall?
Well, declassified Federal Reserve archives from early 1994 showed that then-Chairman Alan Greenspan saw underlying inflation bubbling up. The economy was accelerating rapidly,
Okay.
and rather than waiting for it to become a crisis, he shocked everyone. He aggressively hiked interest rates.
Surprise rate hike.
Exactly. It was the first rate hike in 5 years, and it caught institutional investors completely off guard. The cost of capital just shifted overnight.
And historians affectionately called that event the Great Bond Massacre. And just like today, the S&P's momentum broke instantly. It slid into this multi-week, choppy bleed well below the zero line by late March.
What's fascinating here is that the triggers themselves could not be more different. I mean, today, it's Middle East oil freezing the Fed. 30 years ago, it was a surprise Greenspan rate hike.
Right. But price charts only show us the symptoms. They just show the fever.
Exactly. The human reaction, the mathematical way institutional money reacts to a sudden shift in the cost of capital, is mathematically identical. Both triggers created a trap, followed by a harsh reality check.
Okay, so why do completely different historical events create the exact same market heartbeat? Let's look under the hood. Our sources break this down into 4 specific macro pillars.
Let's get into those. Pillar 1 is Main Street versus Wall Street. If you look at the Bureau of Labor Statistics data from 1994, there's a massive disconnect.
Yeah, the stock market was bleeding, but the actual U.S. economy was booming. They added over 3 million jobs that year.
And we are seeing the exact same resilience in the 2026 BLS reports right now. Wall Street is panicking, but Main Street is working. People are getting hired, wages are stable.
Well, wait, hold on. Let me just jump in here because that sounds completely backward.
How so?
Well, if 3 million people are getting paychecks and spending money, corporate profits should go up. Why on earth would Wall Street panic over a strong job market?
Yeah, it's a counterintuitive dynamic, but it all comes back to inflation. When the labor market is strong, people have disposable income. They buy things. That high demand allows companies to keep prices high, which keeps inflation sticky. Wall Street is throwing a fit because as long as the economy is running hot, the Fed has zero incentive to lower interest rates.
Ah, okay. Institutional investors don't actually care about Main Street's wages. They care about cheap borrowing costs. Good news for workers is terrible news for Wall Street.
Exactly. Cheap money isn't coming back anytime soon. But economic data alone doesn't explain it all. Pillar 2 is the technological supercycle.
Okay, and I want to reframe the panic around this point using an analogy. Think of this phase like a massive home renovation.
I like this analogy.
Right, you're tearing up the floors, dust is everywhere, you're writing huge checks to plumbers, your house is a mess, and your wallet is draining. But you aren't destroying value, you are building the foundation for massive future value.
And we saw the exact same sawdust on the floor phase in 1994. The broader stock market looked flat, almost stagnant, but underneath, it was the quiet, highly expensive infrastructure phase of the commercial internet.
Laying the physical fiber optic cable.
Yep. Upgrading hardware. Netscape was literally founded in April of 1994. It was all outgoing cash with very little immediate return.
And if you look at the corporate earnings reports for 2026, we are in the exact same phase for AI. Hundreds of billions in capital expenditures, CapEx pouring into physical data centers and power grids.
It's a staggering amount of upfront capital before the consumer ever sees a polished product.
Okay, so the market looks flat, but it's just digesting the renovation costs. Which brings up pillar 3, the bond market tantrum. Because how are they financing this with high rates?
The fixed income side is practically identical in both eras. In 1994, the bond market violently repriced because easy money had ended. Today, Treasury yields are doing the same thing because of that higher-for-longer reality.
Let's explain that violent repricing mechanically. If the Fed holds rates high, new government bonds pay a great return. But that makes all the old bonds Wall Street holds instantly less valuable.
Nobody wants your old bond paying 2% when a brand new one pays 5%.
Exactly. Wall Street isn't just complaining. The existing collateral on their balance sheets is actively burning up.
The math is brutal. When U.S. Treasuries lose value that rapidly, institutional investors are forced to sell off other assets, like tech stocks, just to cover their risk. It drains liquidity out of the system.
Okay, so that's 3 pillars. Strong labor market, AI CapEx cycle, burning bonds. But there's a 4th pillar, keeping big money off the keyboard, the political crucible.
And before we dive into this, we must explicitly state, we are not taking sides here. Capital is completely agnostic to ideology. We are strictly observing how money reacts to political friction.
Right, strictly neutral, we're just looking at the data.
So 1994 was a deeply divided midterm election year, the Republican Revolution. Fast forward to today, 2026 is also a highly polarized midterm year.
And institutional money absolutely hates uncertainty.
Hates it. When there's potential for regulatory overhauls, big money just refuses to play. Pension funds, hedge funds, they sit on their hands, park in cash, and wait it out.
Which drains upward momentum. So we've got resilient jobs, massive AI spending, a burning bond market, and midterms freezing capital. So, what does this all mean for the person listening right now whose portfolio is in the red?
Well, we have to look at the midterm historical charts for the playbook. Historically, May to October is the danger zone, or the bleed out. Political uncertainty is at its peak.
Okay, so these choppy bleeding charts in mid-March are likely going to persist straight through the summer.
Yeah, the data suggests we aren't near the end of the friction. But November to December consistently triggers a relief rally, a massive snapback once the election clears.
Because the uncertainty is gone, regardless of who wins.
Exactly. Institutions can finally model their risk and start buying again.
So what was the final outcome for 1994 after all that, after the Whipsaw and the bond massacre?
The market didn't crash. That is the single most important takeaway from all this data. It didn't crash, it just flatlined.
A zombie market.
Yep. It ground sideways for 9 agonizing months, and it finished down a completely harmless 1.5%.
9 months of intense stress going nowhere just to lose 1.5%? That sounds like psychological torture.
It is. But if we connect this to the bigger picture, it served a mathematically necessary purpose. It was a digestive market. It flushed out the speculation and built the infrastructure for the late 90s mega rally.
The dot-com boom doesn't happen without 1994 laying the cables.
Exactly.
And that is the mindset shift for you listening right now. The suggestion here isn't a specific trade, it's psychological armor. If 2026 is a zombie market, don't panic.
Right. Your biggest enemy isn't a crash, it's a boredom.
Don't panic sell your tech holdings just because the chart isn't going straight up. A flatline year is completely normal and often necessary to digest massive technological capex spending.
You have to live the dust for a while to get the newly built house.
Exactly. By looking at the macro engines, the BLS jobs, the capex, the midterm cycles, you can ignore the daily media noise. You're just standing in a construction zone.
The daily ticker is just noise. The structural pillars underneath are the actual signal.
Which leaves us with one final, kind of provocative thought as we wrap up. We know 1994 was a boring zombie market that secretly laid the physical fiber optic cables for the dot-com boom.
Right.
So if 2026 is forcing the market to endure a painful AI infrastructure phase right now, paying the plumbers of a new era, what kind of explosive, world-changing mega rally is the zombie market quietly setting us up for in 2027 and beyond?
That is the ultimate question. The concrete is being poured right now, even if it just looks like mud.
It really does. Well, thank you for joining us on this deep dive. Remember, keep your eyes on the data, ignore the noise, and we will catch you next time.